Hi everyone, welcome to this workshop on climate change, credit risk and COVID-19, a joint initiative of EDHEC-Risk Institute, Long-Term Investors Initiative at the University of Turin and Collegio Carlo Alberto. I am Gianfranco Gianfrate, I am a professor of finance at EDHEC Business School, and I am also a fellow of the Long-Term Investors Initiatives at University of Turin. I started with, one year ago with the Long-Term Investors Initiative, a research project on the relationship between climate change and credit risk. And today I am delighted to have this opportunity to share with you insights and ideas about the extent to which climate change is incorporated in the valuation of assets and investments, with a specific focus on fixed income. I will leave the floor now to Elisa Luciano, Director of the Long-Term Investors Initiative at University of Turin. Elisa, you have the floor.
Thank you, Gianfranco. Good afternoon, everybody. I'm pleased to meet you today. And I'm here both as a professor of finance and as a director of LTI. LTI is a think tank founded some years ago in cooperation with the University of Turin. And the aim of LTI is to provide research, executive education, and above all, workshops and seminars on long-term investors and their quote-to-quote problems. We know that long-term investors by now have more or less 50% of worldwide wealth. So it's important to understand what drives their decisions and which kind of risk-return trade-off they are choosing or they should choose. Long-term investors has been funded also thanks to the willingness of Professor Francesco Profumo, who is today with us. Francesco Profumo is former rector of the Polytechnical School in Torino, former Minister of Higher Education, and among the many positions he's covering nowadays, he's the chair of Compagnia di San Paolo, who is an institutional investor and who is particularly proud to be today and to have been in the past very careful about asset allocation choices in terms of ESG principles. So let me give the floor in turn to Professor Profumo, who will provide us with an overview of the ESG principles and climate change from the point of view, I guess, of both his position as an academic and his position as the chair of quite a big institutional investor, at least in the Italian arena. So Francesco, please.
Thank you, Elisa. Thank you for your nice words. Dear colleagues, dear students, over the last years, the financial industry, as well as its regulatory authorities, have paid increasing attention to ESG-related themes and valuation criteria. As you know, ESG factors include E, the environmental issues such as climate change, population growth, S, the social aspects such as inequality, human rights, and G, the governance themes, good governance practice, respect of all stakeholders' rights, quality and representativeness of boards. Compliance to these factors has become increasingly important for all kinds of financial institutions, and especially for long-term investors who have a greater responsibility to the society. The recent COVID-19 crisis and the policies envisaged by public authorities for the recovery have strengthened the attention towards these aspects, especially to the E. The EU taxonomy on sustainable activities came into force only in July 2020. This is expected to provide a common ground or a hypothetical green list of issuers of financial products, both stocks, bonds, and derivatives. While the S and G standards still need a further levelness, there is utmost awareness of the importance of including ESG-related considerations in the risk assessment and capital allocation processes. This means to understand the relation between a virtuous ESG business practices by the firm and their financial performance, including returns and the riskiness. A practice which is obviously to avoid consists in greenwashing assets, namely labeling financial products as green, when in reality they do not meet environmental standards. Recently, an LTI-sponsored research by Gianfranco, for instance, has highlighted the positive association between firms' exposure to climate risk and credit risk. This association, and more in general, the association between ESG ratings and credit risk, appears particularly relevant in the current environment, in which the evaluation of credit risk in the portfolio of institutional investors requires careful consideration. For institutional investors, the importance of investing in firms with good, effective ESG practices not affected by the greenwashing problem has always been crucial, because such activity allows to generate value in the long term, and because it is in the interest of all the stakeholders. In this historical moment, long-term considerations go hand in hand with a short-term perspective, because investing in ESG-oriented firms should allow to mitigate credit risk exposure. As a Compagnia di San Paolo, we adopt an investment policy which complies to ESG criteria. Since we are a non-profit entity, this behavior is deeply grounded in our approach to investing, and we have been adopting it before it became a global trend. We also carefully consider ESG criteria when we assign grants. Last but not least, we promote the ESG culture in investment and risk management practices, sponsoring initiatives like today's conference and activities like LTI UniTO. Thank you, and have a very nice seminar.
Thanks to you. So now we go from the general principles that I assume we all agree upon to the data, essentially. Our next three speakers will bring all these considerations to the data. In particular, the first speaker, Enrico Bernardini from the Risk Management Department of the Bank of Italy, will provide you with a very interesting number of considerations about the quality of the data on climate risk in particular, and in general on the E part of the ESG, and on how useful machine learning can be in terms of giving predictive views on this E. So I don't want to say more about the gap that is part of the title of Enrico's talk. So ESG, E and climate change, mind the gap, data and fixed income portfolio construction. Enrico, the floor is yours.
Thank you, Elisa. Thank you to LTI and EDHEC for inviting me. I'm very glad to speak about these two topics, COVID and climate change, that are actually considered in the traditional mindset as long-term threats, and now we are fully aware that they can materialize in the very short term. So I will talk about how those risks can affect climate credit risk. First of all, I will briefly introduce how climate change could affect credit risk by the main channels. And then I will discuss about ESG data and the difference and suitability for assessing climate change. And then how climate change and ESG information can be integrated in the construction of fixed income portfolios. And I will end up by talking a bit of the COVID effects on the bond market. So let me first briefly introduce how climate change can affect the whole economy and the financial system, basically by two transmission channels. The first one is a physical risk, being the disruption that climate-related events like wildfires, but also for Italy, as we can see in the bottom left slide, through for Italy, landslide and flooding are the most relevant risk stemming from climate change and physical risk. And also physical risk can disrupt not only business for corporates, but also the wealth of households. And this would translate in the lack of creditworthiness, and so higher credit risk for banks and other investors. The main transmission channel of credit risk of physical risk are not relevant only for Italy, but as we can see in the right bottom graph, but it's relevant worldwide. Another country in Europe, for instance, Germany is on the top 3 on climate change risk index of German Watch, and that suffered losses for 0.12% of GDP last year. So physical risk is imminent and it's relevant. The other channel is
Enrico, sorry to interrupt you. Just a minute to clarify to all the audience that if you have questions on Enrico's talk, you can write them in the chat and we will collect all the questions at the end of the presentations and let the speakers answer. Sorry, Enrico, about that.
Oh, sorry. The option is the Q&A, not the chat. Just to clarify, Q&A.
Okay. So climate change is also channeled to the financial system and the whole economy via the transition risk channel. That means the fact that public policies, investor behavior, and also technical change can affect the wealth and the business profitability of companies. And for instance, we have measured this relevant risk for public electric utilities in Europe, finding that transition risk, namely the carbon risk, has transmitted to profitability and market performance of different public electric utilities that have different energy mix, affecting much more the electric utilities more tilted towards fossil fuels energy mix. So having said that climate change risk is so relevant, let's look at how authorities and intermediaries are actually considering this. Starting from the recommendation of a task force on climate change financial disclosure promoted by the Financial Stability Board in the recommendation of 2017, and more recently the guidelines by the ECB under consultation, and the work of the Network for Greening the Financial System, a coalition of central bank and supervisors committed to foster the transition of the financial system to a low carbon economy, that issued a guide for supervisors. So there is a growing momentum of authorities to support and encourage intermediaries to integrate climate change risk in their key areas. Those areas are governance, strategy, risk management, and metrics and targets. But what intermediaries are actually doing to tackle climate change? Actually, the answer is not so much. According to the overview of environmental and climate change risk analysis performed and issued last June by the Network for Greening the Financial System, there is still a lack of awareness among financial intermediaries. And this is also due to a limited capacity and application of environmental risk assessment methodologies among intermediaries. This is also due to gaps in data and in methodologies, robust methodologies. And this translates also into a low disclosure by intermediaries of the exposure and the risk management practice that they have adopted to tackle climate change risk. But data, as Elisa already said, are utmost important to as a starting point to assess climate change and sustainability risks. I would make the point first that ESG, E, and climate change data are very different. Climate change is just one part of the environmental pillar that ESG providers offer through their scores and assessment. And environmental is also one part of the three pillars. So why investors mainly use ESG data as a proxy of climate change risk? Because we don't have yet enough robust climate change data assessment. And in general, ESG data and assessments are currently facing some challenges in terms of data quality, comparability. The coverage is still limited among the issuers. And then also the ESG scores suffer biases across the size, the sector, and regions of the issuers. These challenges translate into a lack of consistency and quality and comparability of data, as shown by a low correlation of ESG scores provided by different service providers, compared, for instance, with the traditional high correlation of credit rating agencies. Some improvements are ongoing. For instance, I would mention the agreement and the commitment of the major standard setters to harmonize and reduce fragmentation for disclosure standards. I would also mention the EU taxonomy as a seminal contribution to identify activities, starting from green activities, as Professor Francesco Profumo has said. And this taxonomy is so valuable because it considers dual assessment, not only a positive impact, but also negative impact, and financial and societal impact altogether. Mandatory regulation is also another point that is important to reduce, to enhance coverage and to reduce inconsistencies. In this aim, I would mention the EU regulation to low carbon benchmarks and also to ESG information and disclosure by asset managers. And transparency methodologies by ESG providers is also very important to reduce uncertainty and to enhance trust of investors in using this information. But looking at ESG data and climate change, how do they relate, and how can we rely on ESG data as a proxy of the climate change? Actually, we have performed, as Elisa said, a machine learning application to ESG data points and metrics of the two major ESG providers, namely Refinitiv, Offset4, and MSCI ESG, using more than 200 metrics and their scores of the two providers. We evaluate how financially material are the single data points to portfolio constructions for an equity portfolio construction, I would clarify. And we found that climate change is not so exploited as important information within the ESG scores as a whole. And it would merit much more attention. For instance, the forward-looking evaluation of environmental issues and climate change risk would contribute to set up more efficient portfolios compared to the standard ESG scores. For instance, we found very, very informative information regarding renewables and clean technologies. And in general, transition risk can be assessed through the exposure and the ability to manage climate change risk by companies. Moving to what we have still to do for assessing climate change, I would mention the methodological issues, because while carbon intensity is mainly backward-looking, looking at the actual condition of the companies, we need more forward-looking assessment, as Professor Gianfrate has said in the introduction. And the challenges in this field are more related to modeling, uncertainty, endogeneity, and non-linearity of climate change, that if we think about, they are very common and shared with the COVID crisis. Endogeneity of climate change is very similar to contagion risk of the COVID crisis, because climate events can cause new climate events. Let's think about global warming, producing Arctic ice melting and sea level rise and flooding risk. Just to mention a kind of a disruption chain. And to afford these kind of challenges, we need to simplify the assumptions and the major solution could come from scenario analysis and stress testing. In this field, the Network for Greening the Financial System that the bank has joined since last year and is acting as an important contributor, has issued a scenarios that would serve as a reference for the financial system at global level. Now, moving to managing a fixed income portfolio with ESG factors, I will start looking at how relevant are ESG factors to fixed income performance. First, I would like to clarify that ESG data coverage is still limited for fixed income space, while the equity coverage is quite larger. And among the ESG factors, if we look at the three pillars, we have performed internally some assessments of the relevance of ESG factors within the European bond market in the period spanning from 2014 and 2019. And we found that there is a negative correlation between ESG and spreads. This means that the higher ESG scored companies can benefit from of lower spreads, so they are evaluated as less risky by the market. And this is true not only at the moment of the assessment, but also with the return 12 months later. We found still a negative correlation. And this negative correlation holds true not only for the ESG as a whole, but also especially for the governance, which is the most material pillar to provide positive return differential. The same result is confirmed by the analysis of Bloomberg Barclays for the US market, where and Sustainalytics, where Sustainalytics and MSCI scores on governance comes out as more material to contribute to construction of bond portfolio with ESG tilt, with the positive differential. So in bond portfolio construction, how to integrate ESG factors. I present the case study that we have made internally at the Bank of Italy, and we found that combining standard financial factors with ESG factors doesn't sacrifice return, but rather the opposite. It can enhance the return while keeping the tracking error in a sample replication strategy, keeping the tracking error quite low. This exercise is made on the same time span 14-19 that I have mentioned before. So combining duration and spread and ratings of the issuers as a stratified sampling drivers with the ESG scores and governance scores, we found that, for instance, if we look at the graph on the bottom right, we see that duration times spread plus rating and ESG strategy can enhance the return. It's the green point in the picture, and also using a minimum threshold of the ESG can enhance the return, while the tracking error is still very low, between 5 and 6 basis points. Let me now talk about the effects of COVID crisis into the market, of the bond market. We have seen in the first half of 2020 a growing issuance of social and sustainability bonds, and this is due not only to the investor attitude and public pressure, and but because also of the issue of by ICMA of sustainability-linked bond principle. So the huge increase of issuance is quite remarkable, and can be seen together with a slow down of increase, the long-term increase of green bond issuance. That is anyway still in the upward trend, as we can see in the bottom left graph, where the share of sustainability bond that mix together green and climate change targets with more social use of proceeds. And but one other important element to consider is the green government bond issuance. The green bonds issued by the governments, especially during the COVID crisis, and in perspective, could help the market to be more liquid, to build up the yield curve for green bonds that are really material to measure the greenium and the differential between green bonds and standard bonds, and make the secondary market of green bond more functional. I'm ready to close my presentation. I think I'm on time.
Thank you, Enrico. I would leave the floor to Gianfranco, who is ready to introduce the next speakers. And as mentioned before, please continue writing your questions on the Q&A section, so that later on we will be able to convey to the speakers all the questions from the audience. Gianfranco?
Thank you, Elisa. Next speaker is Riccardo Rebonato. Riccardo has a doctorate in nuclear engineering. He held senior positions at Barclays, Royal Bank of Scotland, and PIMCO, and is currently a professor of finance at EDHEC and the lead expert on climate change research program at EDHEC-Risk Institute. So Riccardo is uniquely positioned because he understands the science of climate change and energy. He understands the theory of finance, but he also knows firsthand how investments and finance is done on the desks of major investors. So Riccardo will discuss the promise and perils of climate-aware investing. Riccardo, you have the floor.
Thank you very much. It's an incredibly kind introduction. I hope I'll be able to live up to such a bill, and I'll do my best. So I'm going to talk about climate-aware investing, and meaning by that, what is the impact we can expect on asset pricing and asset prices, both in the fixed income area and more generally, from our efforts to abate climate change. And I will be starting from talking about integrated assessment models. In particular, at EDHEC, we have re-implemented one of the best known integrated assessment models. As we all know very well, these models try to, in a simplified way, to combine a description of the physics of climate change with a description of the economy of climate change. And the two things obviously interact, because how much the economy grows, industrial production, affects the climate. And if this production is obtained by big emissions of CO2, then there is a negative effect via the climate onto the economy and production. So it is an endogenous system on a system with feedbacks. And we have adapted and rejigged one of the best known integrated assessment models, which is DICE, produced by Professor Nordhaus at Yale University. And I will be starting from what comes out of the improved, I wouldn't say improved, but the altered DICE to start our discussion. So the first point that I would like to make is that there is, when it comes to the impact on asset pricing, there is an absolute dimension and a relative perspective. By absolute dimension, I mean that holders of financial assets, the providers of capital, will reap the benefits of what the economy produces after labor has been paid. So to the extent that climate change affects future production, then the fraction distributed as dividend and interest will change. So whether we can expect the stock market and we can expect assets in general to perform well is obviously linked to the performance of the economy. And then there is a relative perspective. Depending on the climate outcome and on the degree of abatement efforts, some sectors will do better than others, which is almost obvious. But the point I would like to make is that if we indeed do something meaningful to control climate change, this will necessitate, this will imply, this will require fundamental changes of the resources, how we deploy resources in the economy. And I will give one detailed example of that. So let's begin. What does the DICE model says? It's very well known that the DICE model says, don't invest a lot at the beginning. So these are the output of the DICE model. There is the optimal savings fraction and the optimal abatement fraction, how much we should invest in productive activities and how much we should devote to climate change abatement. That is the blue line. And it's very well known, it's quite controversial that DICE says, don't do much now. It's much better to do later. And in a nutshell, the idea is that we are going to be richer later, and therefore the same sacrifice in terms of climate abatement in percentage terms, or rather in decreasing utility, will hit us less when we are richer later on than today. That is very well known. And along this deterministic scenario, the DICE scenario is deterministic. We have that in 100 years' time, the temperature anomaly will be about 4 centigrade. And if we look at the damage fraction along the optimal path, this is assuming that we act optimally, at the beginning is very limited. So it's a few percent, which is in a way rather surprising. I want to stress that in the DICE model by Professor Nordhaus, there are no tail events in climate change. Everything, it is, I wouldn't say normally distributed, but certainly it is not a distribution of events, of outcomes a la Professor Weizmann from Harvard with very fat tails, but it is a thin tail distribution of events. One very simple thing to do is to say, what if we keep all the parameters of the Yale Professor Nordhaus models at the same central level, but we add uncertainty? The moment you add uncertainty, given the concave nature of utility function, you immediately see that you have a very different solution. And the different solution is we should be doing a lot now. That is the blue line. Now the blue line is now declining. The optimal time to invest heavily in climate change is today. And if we do that, then we have a temperature anomaly, which is a bit lower. And we have a damage fraction, which is also a bit lower. Again, also in this case, there are no tail events. Okay, so the first comment when it comes to asset prices, and therefore the size of a pie consideration, according to these prevalent integrated assessment models, typically they have a deterministic path for growth. So the growth path is exogenous. And it is rather stunning. In 100 years, according to the DICE model, we are going to be approximately 10 times richer than we are today in real terms, which means that the world will be, on average, about as rich as Luxembourg is today. I hope they're right, but it seems to me a very, very optimistic extrapolation, especially because no uncertainty around it is allowed. And the moment you put uncertainty, everything changes a lot. So even after inducing a front-loaded abatement schedule, the growth remains very similar. And also we have noticed that the dice damage fraction changes net production very little. So according to all these projections, providers of capital will do extremely well or very well. So the uncertainty is we're going to do well, very well, extremely well, super well, which I would say is it perhaps another case of Ramsey's weakness of imagination, which was in this related context. So that is the first thing. Second thing, I am conscious of the fact that I only have 20 minutes, therefore I will go to brisk space. So that is the size of the pie. Let's look at the sector differences. And I'm looking at one particular aspect to highlight the war effort type of investment that we have to make if we want to abate climate change in a serious manner. What I have in these graphs here, it is again from the DICE model, and this is corroborated from reduced forms physics studies. And the yellow line here is our emissions, and there are 4 scenarios. The first scenario, we find a magic bullet, and we find something that allows us to stop emissions extremely fast. You see the yellow curve that drops virtually to 0. This is the incredibly good scenario. The second scenario on top right is a very aggressive reduction scenario, much more aggressive than anything which is on the cards. And then we have a sluggish scenario. And the last one is we keep on exactly as we are at the moment, like there is no tomorrow. The important thing to notice is the gray curve. Even in the most aggressive scenario, the concentration of CO2 remains extremely high. This is because the removal, what is called the e-folding time of CO2 concentration in the atmosphere is very, very low. Original estimates used to be 75 years to 100 years. Now the latest estimate is of the order of thousands of years. And by the way, in case you were asking, the concentration of CO2 has been going up virtually in a straight line in the last decade. So why is this important? Because this tells us that just finding good renewables is not enough in order to solve the climate change problem. Temperature doesn't know about emission. Temperature knows about concentration. If the concentration responds very slowly to emissions, we have to remove actively CO2. And indeed, in all the scenarios which are 2 centigrades or 3 or 4 centigrades compatible of the IPCC, there is always on page 322 something, a big contribution coming from negative emission technologies. So serious climate management requires sequestration and storage, negative emission technologies. Both, and this is the point I'm coming to, require infrastructure investments on war effort scale. Negative emissions without enormous competition for land requires sequestration and storage. If we have BECCS, which are bioengineering, carbon capture and sequestration, or forestation, the use of land to make a difference is absolutely enormous, and it would compete with agricultural use. Atmospheric sequestration is very energy intensive. It's so very energy intensive that if you want to make a dent, more energy has to be produced by renewable sources or by nuclear for sequestration than for the energy uses that we have at the moment. Such an enormous deployment of renewables requires either massive subsidies, which have to be either via taxation or by increasing public debt. So moving from climate facts to asset prices. 2 situations. If serious action is taken to curb climate change, the allocation of resources in the economy will be transformative. It will be major. I have just made the example of the negative emission technologies, but we have everything points in the same direction. I teach my students, if we cover every single roof in the UK with a solar panel, every single roof, we only produce enough energy to cover 20% of the consumption of energy for individual car transportation. So if we want solar panels to make a difference, we need to have solar panel farms which have to be deployed alongside windmill farms, which compete with land. Anything we look, these windmills will require an enormous amount of steel, an enormous investment in infrastructure. So all the point here is that if serious action is taken, we shouldn't take a marginalist approach. Oh, it's a small perturbation around what we're doing at the moment. If we go down that route, the resource allocation will be massively different. On the other hand, if serious action is not taken, well, then there could be negative repercussions, serious negative repercussions on economic growth. So we are in a way between the Scylla and Charybdis of a change, an unknown change, basically, in the allocation of resources in the economy, or an unknown outcome if we do nothing. Both these factors will have implication on the overall level of assets, the size of the pie, and the cross-sectional variations in assets returns. Net returns to capital providers and return to labor may change, depend on the level of taxation, the level of infrastructure commitment. Asset prices in general can be expected to have cross-sectional variation in their temperature exposure. One source, is only one source of this cross-sectional variation, is the exposure of their payoffs to macroeconomic growth risk, for instance, consumption risk. Since climate change affects consumption dynamics, assets that are highly exposed to consumption growth risk are highly affected by climate change risk. There is a recent paper by Bansal, Kichu, and Ochoa showing that cross-sectional difference in consumption risk in assets dividends translating to cross-sectional differences in temperature risk in assets returns. Now, there are several approaches to try to divine or to predict or to guess or to estimate or whatever you want to say the impact of the E of ESG, and the temperature is the easiest thing to quantify on assets. The prevailing market signal approach could be very simplistically described as determining the sensitivity of different assets to climate, temperature, read from the changing prices to the changing temperature, the climate beta of an asset. And then if you want your market price of climate risk, being long and short portfolios as to extract the climate factor. The assumption is a very strong version of the informational efficiency of prices. And this I find difficult at the moment to accept as readily as I normally would, given the enormous price distortions in all asset classes brought about by quantitative easing, partly due to the COVID crisis that we are in. To the extent that the prices are completely disrupted by quantitative easing, it's very difficult to read the signals in the prices. What else could one do? Well, I am just sketching here. I'm looking at my watch and I'm going to go very briskly. A different approach would be to consider three scenarios: business as usual, muddle along, optimal action. And the redirection of resources, the size of a pie, and the cross-sectional variation changes a lot in these three scenarios. So in the approach that looks useful to me, I would focus on the small number of key scenarios as above, and for each scenario, work out the implications for the economic growth, the size of a pie, the level of government debt and interest rates required to finance the abatement efforts, the cost of capital, the level of taxation, the level of required infrastructure investment with the consequences on employment and pricing power of labor, and inflation. What is the difference here? That now we only, and I put only in treble quotes, have to establish the sensitivity of assets to macro-financial quantities for which we have greater experience and greater data, and then average over scenarios. One way to do this, and part of my research in stress testing is to do with Bayesian nets. And here I have set up one such Bayesian net in which from the level of commitments in 3 states, serious, window dressing, and low, fits down to the infrastructure investment, possibility of technological breakthrough. These two fit into the temperature anomaly. The infrastructure investment feeds into the level of taxation and the level of debt. Temperature anomaly, level of debt, level of tax feeds into economic growth. Then we can now cascade down to assets such as equities, safe treasuries, risky treasuries, etc. This is just a sketch. So conclusions. It is currently difficult to use integrated assessment models to gauge the impact of climate change on asset pricing. It is clear, however, that serious management of climate change requires major redirection of productive capacity. On the other hand, failure to have could have economic consequences more severe than what many integrated assessment models currently project. The outcome for prices is strongly scenario dependent as a cross-sectional and a size of a pie dimension. Working out the sensitivity of asset prices to the macro-financial variables affected by climate change may be easier than estimated a climate beta. Perhaps I've tried to put too much information in my presentation. I hope it was clear. I would welcome your questions if you have any in the Q&A question. Thank you very much.
Thank you very much for your presentation, Riccardo. You gave us a lot of food for thoughts.
Indigestion.
Our next speaker is Giorgio Baldassari. Giorgio has a PhD in quantum mechanics, and he later joined Berkeley's, and is currently at Standard & Poor's, where he's the global head of the analytic development group. And he's basically in charge of the validation of credit risk models. Needless to say that rating agencies are at a critical juncture in the relationship between issuers and investors. And Giorgio is one of the thought leaders in this field. So we are very pleased to have him with us today. Giorgio, you have the floor.
Thank you very much, Gianfranco, and hi, everyone. First of all, it's a pleasure being invited at this workshop with other esteemed colleagues. I would like to start and to introduce the topic of my discussion by showing this heat map of the world. I give you a few seconds to guess what this is all about. I assume you can easily recognize some of the countries that contribute the most to the production of greenhouse gas emissions. However, what if I tell you that this has nothing to do with carbon emissions? What if I tell you that actually this heat map shows the death toll due to the current pandemic as of mid-October? And I chose to start with this, not only because we really live in unprecedented times, but also for 3 reasons that link this pandemic to climate change in a more or less direct way. The first one is that governments are considering how to facilitate greener and more sustainable investments as they think how to relaunch the economy. The second is that, paradoxically, this pandemic has given a hand to the climate agenda by triggering forceful lockdowns that ended up reducing greenhouse gas emissions production quite sizably. But this obviously comes with very dire economic consequences. And the third reason is that there is mounting evidence that actually climate change can facilitate the spread and proliferation of certain virus and other diseases. And this is actually well known since 20 years ago. And mind, I'm not saying that this specific pandemic is due to global warming, but this can certainly facilitate the onset of some future epidemics that, if not properly managed, could transform and evolve into pandemics with dire economic consequences. And this adds to the well-known losses that businesses experience due to physical events caused by global warming, and that currently stand at around $100 billion a year across the world. And to reduce these physical risks, many governments have committed to curb emissions by introducing or increasing a carbon tax as one of the major policy tools and facilitating the transition to a greener economy. But this transition introduces new challenges and can impact banks' lending books or investment portfolios. So here I show a few examples of how physical and transition risk can impact banks' lending books. On the risk side, we can see the depreciation of the site of a commercial borrower used as a collateral due to natural events, thus increasing the expected loss for a bank, or the reduced liquidity of a borrower due to increased investments into new and greener technology, or the increase of a carbon tax, or the loss of earnings due to actions of environmental activists or consumer boycotts, such as we saw last year in London during a demonstration that disrupted the whole public transport for several hours. All these things have a negative impact, obviously, on the creditworthiness of borrowing companies. And on the positive side, companies may in fact increase their profitability by improving their efficiency and reducing costs due to innovative technologies, or even gain market share by decreasing their prices and thus improve their competitiveness. And all these things would have a positive contribution on their creditworthiness. So many financial regulators have started introducing climate-related scenarios in banks and insurers stress testing exercises. And in pole position, we see the Prudential Regulation Authority, not only because I'm based in London, but also the European Banking Authority, France, and many other countries. And even in US, last year, the Senate passed the bill that requires the US Federal Reserve to start considering climate-related scenarios and impacts in stress testing exercises. Now, scenario analysis is a well-known and established tool in risk departments of banks and insurers, but climate-related scenarios present unique challenges and new challenges that were already mentioned partly by my colleague Enrico before, such as the need for accurate and company-specific data on carbon emissions, the geolocation of where the emissions are produced, and the firms, as well as the geolocation of the firm's fixed assets position. The time horizon that spans several decades, so much longer than classical stress testing exercises, and the existence of both risks and opportunities. And finally, just to make it round, the lack of a well-established approach to combine climate data and link them to credit risk impact. In fact, in a recent survey by the European Banking Federation, more than 50% of the respondents identified this issue as a primary concern. So at S&P Global Market Intelligence, we have developed two approaches that link climate-related transition scenarios, in particular related to carbon tax increase and credit risk. And the first approach is actually estimating the firm's pro forma company financial statements depending on various carbon tax scenarios. And it was developed in collaboration with Oliver and Wyman, initially covering the upstream oil and gas sector, but is currently being expanded to other sectors, energy-intensive sectors, such as the metals and mining, power generation, automotive, and so on. And the estimated financials can then be used in fundamentals-based credit risk models, such as our own credit model that approximates in a statistical way an S&P global rating, or also they can be used obviously inside the bank's own credit risk internal models. And this approach is very sector-specific and data-intensive and provides a bottom-up view of credit risk that usually resonates pretty well with banks' fundamentals-driven approaches and is particularly useful for large exposures in energy-intensive sectors. But we have also developed a complementary approach that estimates how main financials and market capitalization of companies change depending on a carbon tax increase. And the future market capitalization can be also plugged into a Merton-like model to determine the change in credit score of a company in notches. And this can also be used in conjunction with other banks' own internal models to assess the credit risk impact of various carbon tax scenarios. And we are also planning to add physical risk considerations in a future iteration of this tool. And this approach is applicable to companies across all sectors, both public and private, with obviously an appropriate estimate of the market capitalization for private companies. And so this tool is particularly good for scaling the analysis of the credit risk impact to thousands of counterparties across all sectors with a consistent and fast yet accurate approach. And this is the tool I will use in my to perform an analysis of the transition risks and opportunities due to various carbon tax scenarios for European Union publicly listed companies. And I'm now going to present the results of this analysis. So this slide shows the total additional yearly costs that publicly listed companies in the European Union will incur by a certain year from 2020 to 2050 under various carbon tax scenarios. We use true cost predefined scenarios that include a slow, moderate, or fast carbon tax increase and take into account different taxation levels by country and within each country by industry. And we also take into account the geographical breakdown of emissions of each company, because especially large European companies produce a good chunk of their greenhouse gas emissions outside Europe. And the green lines refer to a slow increase of the carbon tax that is projected to reach up to $60 above current levels by 2050 per ton of CO2 emissions. The moderate and the fast scenarios are aligned with the 2 degrees global warming by 2050 and consider a carbon tax hike of $120 above current levels in average. The dashed lines show what happens if companies keep operating their business as usual, paying increasing carbon tax on increasing emissions. And in this case, over the fast transition, this is the dashed red line, companies will face an additional $500 billion in carbon tax costs by 2050. Over the slow transition, the green dashed line, the additional costs are theoretically much lower, but we need to remember that our analysis does not include the impact of physical risk events that actually Professor Bonato mentioned before, that are obviously expected to increase both in frequency and severity if greenhouse gas emissions keep increasing. And anyway, are already locked in for what he was showing before. So there will be an additional effort to reduce actually the current concentration of CO2 and in the environment. And over the continuous lines, we assume that companies will adopt new and greener technology and will reduce their emissions. And the good news is that over a fast transition, the overall additional yearly costs due to the carbon tax hike are not necessarily higher than in a business as usual case, provided obviously companies manage to swiftly reduce their greenhouse gas emission production. For the adaptation case, we include also the abatement costs that need to be sustained by companies to adopt new and greener technology and thus reduce their greenhouse gas emissions. And in this slide, I show the geographical split of the abatement costs based on where the companies are domiciled in the European Union as a fraction of their revenues. This gives us an idea of the level of effort that will be needed by companies headquartered in different countries by 2050 to transition to greener technology. I'm not saying to abate the current greenhouse gas emissions that are already concentration that is already locked into the atmosphere. So we can see some countries where the effort is relatively minimal, like Sweden, Ireland, and Denmark, and few other countries where major efforts will be necessary, such as Greece, Poland, and the Czech Republic. This is again just to look at the abatement costs to transition to a greener economy and to reduce the current production of emissions, not the current concentration already locked into the atmosphere. Now, the carbon tax increase and the abatement costs may represent a small fraction of the overall revenues of these companies, but can have quite an impact on their credit score, as I show in the coming slide. So here I actually show the overall distribution of change in credit score for all companies in my study. And this is plotted for the fast transition, where the carbon tax increases quite a bit between 2020 and 2050. And the bars of different colors refer to various types of responses by different companies. And please note the logarithmic scale for the y-axis that allows me to zoom in on the small numbers of companies changing their credit score in details in particular. So the credit score improves to the left-hand side and deteriorates to the right-hand side. Let us start from the right-hand side and move to the left-hand side. So to the rightmost hand side, we see a number of companies defaulting. And here we consider only so-called technical defaults that happen when the future market capitalization of companies modeled by our model fall to zero according to our model. Let me stress that we neglect the impact of the overall credit cycle, as well as the company-specific defaults due to idiosyncratic reasons. And this would obviously adapt to the technical defaults, but in my discussion, I just want to focus on the pure effect of a carbon tax hike. The red bars refer to the case where companies do not have enough time to adapt to adopt greener technology, and governments impose stricter caps on production of greenhouse gas emissions or impose bans on highly polluting materials. This is a very draconian and tail type of risk and generates many more technical defaults due to the massive revenue losses. In this business, in the business as usual case instead, the amber case, there is still a certain number of companies defaulting because companies pay higher carbon tax on increasingly higher carbon emissions. And let me stress again that here we look at technical defaults due to a carbon tax hike and neglect the impact of the additional defaults due to physical risk losses that obviously would be expected to increase by 2050 if carbon emissions keep increasing. In the adaptation case, so the green bars, we show, and we see actually the lowest level of technical defaults because the additional abatement costs for the transition to greener technology are more than offset by the reduction of carbon emissions altogether. In the center of this plot, we see a solid chunk of companies whose credit score is not affected, and this is up to approximately 40% in the business as usual case. And moving to the left-hand side, we see also a great number of companies that in theory can experience an improvement in credit score due to the increased demand of goods and services by 2050 due to the average increase in world population. Here, we assume that companies maintain similar levels of liabilities and other operating expenses as of today. But what if instead companies do not manage to maintain their current levels and start increasing actually the operating expenses and potentially the liabilities by 2050? And this is what I'm going to show you in the next slide, where we assume that these operating expenses and in fact total liabilities will increase at pace with the projected average economic growth by 2050. And in this case, the long tail that you saw before to the left-hand side almost disappears. And there is an increase on the right-hand side. So we see many more companies with a deterioration of a credit score. And this is obviously easy to understand because in addition to the carbon tax hike, companies will be exposed to further costs beyond current levels if their operating efficiency does not improve. And as a result, we also see an increase of companies at risk of technical default. Now, to be fair, this is a simplification. These are scenario analysis. This is just what-if analysis. And it's hard to say which narrative will be more realistic because we can imagine some companies will manage to keep their additional costs low at similar levels potentially, hopefully as of today, like in the previous slide, while other companies may see an increase of all operating costs by 2050 and also of their liabilities in a situation closer to this plot. So probably the reality will be something in between these two extreme cases that I discussed. However, in the final part of my analysis, I will assume that companies will manage to limit the increase in total liabilities and operating expenses so I can gauge the pure impact of the carbon tax hike on companies' creditworthiness under various response types. So this slide shows the cumulative rate of technical defaults by 2050, between 2020 and 2050 for a fast or a slow increase of carbon tax, assuming, as I was mentioning before, that other operating expenses and liabilities remain at similar levels as of today. I remind you that the technical defaults refer to model defaults, where the market capitalization of a company falls to zero by the time horizon considered here, and should be added on top of the additional default rate due to the overall credit cycle, as well as the company-specific defaults. And the slow transition obviously offers less risk from a carbon tax increase perspective, but is more exposed to physical risks that we do not include here. And let me add a little anecdote. A few weeks ago, I was speaking with a journalist, and he was arguing that the European Union companies are not so much exposed to physical risks, apart from obvious flood risks that we know well in Europe. But we need to remember that almost 50% of the greenhouse gas emissions produced by European Union publicly listed companies are actually produced outside Europe. So because especially large companies operate in many different countries, so they will be exposed to many other type of risks, not just flood risks. Over the fast transition in red, the technical default rate reaches around 2% by 2050 over the business as usual case, and is less, obviously lower, in the adaptation case. And overall, 2% is only an average default rate, but varies quite a bit by country if we look at the company headquarters. So in this slide, I show you the cumulative default rate by 2050 split by headquarter country. And this we can see, as we can see, there is a big variations. There are big variations, and the default rate can reach close to 10% over the business as usual case for the Czech Republic on the left-hand side under the business as usual case. Now, some of these results may look counterintuitive for some countries, but we need to remember that the default rate is driven by the number of companies headquartered in each country and also by the industry sector in which companies operate. So perhaps a better insight can be obtained by looking at the cumulative default rate by industry sector, as I show in the next slide. And this is actually the last slide of my presentation. So based on our analysis, over a fast transition with a carbon tax increase by 2050, the industry sectors at highest risk of technical defaults will include the materials, the utilities, and the technology, hardware, and equipment in the business as usual case in yellow. And interestingly, there are some sectors where the risk remains elevated even under an adaptation scenario, such as the technology, hardware, and equipment, the energy sector, and the automobiles and components. And this is primarily due to the big efforts needed by these sectors to convert to greener, lower emitting technologies. I conclude here, and I actually leave this slide that summarizes our findings. I just would like to highlight there are a lot of assumptions. We don't include physical risks. We don't include extreme events. This type of analysis is obviously predicated on all the assumptions and the narrative that we added, but we still believe it's useful as a tool to engage an idea, engage what the future may bear within the limits, obviously, of this assumption. So I thank you for your attention, and I welcome later on your questions. Thank you.
Thank you very much, Giorgio. That was really, really insightful. So now we are going to have a sort of final section for our workshop. That is a section for Q&A. So we have about 10 minutes at this point. I see that Riccardo has been very active, and he has already addressed most of the questions that were just targeting his presentation. So we will probably go ahead and read some of the questions that are for the other two speakers. So I see that there are a lot of requests for having the slides published on the website, also offline. So we will maybe check with the three speakers whether they are willing or it's possible for them for sort of institutional reason to make the presentations public. And so we will let you know as up. I will maybe invite Elisa to take the floor and maybe go through the questions for Enrico, if you don't mind.
Yes, sure. The questions for Enrico are quite a number. Let me try to summarize some of them. First question is how robust your conclusion on credit spreads and their correlation with ESG scores are with respect to the data source. So whether they depend on the particular data you used in your assessment or not. The second question is the role and the advantage of machine learning. So why did you adopt machine learning, and how do you assess the pros and cons now? There is a third question which I would address myself is we have been talking about publicly listed bonds, as far as I understand. What is your understanding of the correlation between ESG and credit spreads or bond spreads as far as private engagements are concerned? Do you think that given the interest today of long-term investors with respect to the ESG factors, we can expect even a higher sensitivity of the returns on bonds which are, say, distributed through private placements? Or do you think we can sort of make a parallel between the behavior of publicly listed bonds and private credit, essentially? Thanks.
Okay, thanks, Elisa, for summarizing the questions. Just let me start with the first one. So the evidence of the negative correlation among ESG factors and spreads is based on some of the providers. I've used MSCI, while Barclays used Sustainalytics and MSCI. Of course, as I showed, there is a low correlation among providers in their ESG scores. So the results of different exercises might drive to different conclusions, but in several studies underline the importance of the governance score relative to the other pillars. Maybe the magnitude of this materiality could change across providers, but I think in substance the conclusion might not be changing. Apart from the fact that investors are increasingly aware of ESG topics, as you mentioned, Elisa, also for the private market that I will deal later. And this would bring me to say that market valuation, not only in the bond market, but also in the equity market, are not completely reflecting climate change and environmental risk assessment. One very basic reason is that we don't have enough robust tools to assess climate change risk. So if we don't have tool, how can we measure it, and how can I price it? Fully price climate risk into asset prices. So this is, I mean, a basic idea. Of course, there are other information that bring me to say that climate change and ESG topics are not fully reflected in the market. For instance, the fact that the ESG awareness is increasing, but is still limited. We can see, for instance, that ESG funds, both in the equity field and in the fixed income field, is still a very limited share. Think about that. Green bonds are only 3.5% of the global bond issue outstanding. So we are still at an early stage of integrating ESG criteria into investment decision. This is for the first answer. The second, about machine learning, I would say that we have used machine learning because it's a model-free technique. So we didn't need to set up a model assumptions like in the traditional mean variance approach and model portfolio theory approach we would have needed to. And then machine learning technique can help us to identify the most material information among more than 200 ESG metrics. So we apply a decision tree framework that we keep very, very simplified, because we know the shortcoming of machine learning, that it's a difficult interpretability of results, but sticking on a simplified framework of 3 nodes, we could identify and make some and to grasp the economic significance of our exercise. Turning to the third and last question, your question regarding, Elisa, the private versus public market and the relevance of ESG topics. I would say there is a general very good demand for private debt, not only for the sustainable debt, but in general. But I would say that for sustainable debt, this is utmost needed, because we should think that most of the sustainability investments would be needed in the infrastructure, also in long-term projects. And so private debt would be a very suitable solution for support and redirect funding to green investments. And what about the ESG factors in the private market? We don't have, at least as far as I know, we don't have a clear evidence of the spread, the differential between ESG and non-ESG private debt. It's quite difficult to measure, not having a broad information in these. But of course, given the high demand for green investment by institutional investors, I am thinking of pension fund, but also large asset owners, also sovereign wealth funds, as far as I know. So there is a good chance for the placement of private ESG debt. I hope to have addressed your questions.
Absolutely, yes. That was a very exhaustive answer. Thank you very much.
Okay, thank you.
Thank you. So Ricardo has addressed all his questions already online, but let me ask him if he can elaborate a bit on the concept of Bayesian net and the extent to which this tool can help us in understanding and modeling these kind of problems.
Thank you. Thank you for asking this question. Bayesian nets are simply a tool, a mathematical tool, which has the added advantage of being very intuitive, and it gives the ability to assign conditional probabilities in a structured way so as to reach conclusions from root events, making sure that we can follow the dependencies of the events in a logically solid manner. It's a super condensed description, but the key point is that presenting a Bayesian net to a senior decision maker, a policy maker, he or she can follow the logic, resting assured that behind the scenes, all the mathematics works fine. So it is a tool which is not just powerful from the mathematical point of view, but has also lent itself to interaction at policymaking, board level, etc., etc. So that is, I think, one of the big advantages of it. And it lends itself perfectly exactly in situations when you have distinct possibilities. Either we do nothing, we do window dressing, we do things optimally. And then consequences flow with conditional probabilities down these channels into what is called the transmission channels, from the roots to the leaves of a Bayesian net.
Thank you, Ricardo. Very clear indeed. I have two questions for Giorgio. One is about the assessment and quantification of risk for privately owned infrastructures. And the other one is about the transition risk, and in particular, the policy tools that are in place and can be used in this context.
I didn't unmute myself, sorry about that, thank you. In terms of project finance infrastructure, I think this is very challenging. So it's really not trivial, especially when there are no data or there is a lack of information about them. I don't want to pretend that we have a magic wand about it. My team develops statistical models quantified, so it's definitely a major challenge, but we have another team, let's say neighbor to my team within our company that develops scorecards. So we have these scorecards in particular that can capture some of these components and some of this expert judgment, in this case, needed to assess the project finances. There are also some projects that we are running in parallel with some other collaborators externally with other financial practitioners to try to come up with a framework that can help solving some of these issues. But at the moment, it's really at the early stage, so I cannot mention much more than this, I'm afraid. And sorry, what was the second question, Gianfranco?
The second question is, what is your take about the policy in place? So you think that the carbon tax is the main or best way to go?
Okay, so thank you for the question. So I think my analysis is exactly trying to understand a bit more in detail this. I remember we did a paper some months ago that was published by risk.net, in which we are looking at the impact of carbon tax on the creditworthiness of companies. That paper raised some concerns as well. So one journalist reported it as Dr. Baldassari is predicting that if the carbon tax increases by 2050, there will be another global recession. So I was really disappointed by that, because obviously it's stretching out the analysis beyond putting it out of context. I think that the analysis at the time, and this one too, are driven by the components and the assumptions that we're making. It's really important to remember this, and also some of the components that we are missing, like the physical risk events that we don't include. I do believe that the carbon tax personally is an important policy tool, and there are already countries that show and seem to be more advanced, like Sweden, for example, or other Nordic countries, in the way that they manage carbon emissions in the company for the companies that operate there in those countries. An alternative could be to use a carbon quota, limiting the amount, but that one usually is also used by some countries and defaults back to the carbon tax whenever companies exceed that carbon quota. And we have used only specifically the carbon tax in our tools because we want to align with the requirements of the Bank of England that for these climate-related stress testing scenarios do include specifically the carbon tax as one of the major variables for these stress testing exercises.
Thank you, Giorgio. I will take maybe the last question from Florian for you, Giorgio. In the transportation sector, airlines, for instance, seem dependent on the aircraft manufacturers developing new technologies to lower carbon emission. As such, it appears that they have no other choice but to keep doing business as usual. And this seems to be a major threat, especially in the current context. So how could they adapt and become resilient in case of increasing carbon tax?
That's a very powerful, that's a very good point. So this is this dependency is also partly not true just for these industry sectors, but for many other customers that tend to rely on big supply chains. This is also somehow linking to the topic of scope 3 emissions. So scope 1 and 2 are the direct emissions produced by a company. Scope 2 emissions are due to the consumption of energy and heat and gas and steam. And the scope 3 are really the emissions produced upstream by the providers or by the suppliers of those companies. In that case, yeah, there is not much that they can do except probably for changing a provider depending on what they see, if these providers are obviously changing their contributions. And in our tools, obviously, we need to take into account this other component that, as Enrico Bernardini was mentioning at the beginning, is another lack of information. So lack of data, standardization, especially scope 3 emissions are really missing pretty much. And it's an important component, however, that needs to be considered.
Thank you, Giorgio. So I think we are running out of time, and before leaving the floor to Elisa for final remarks, I wanted to thank you very much, all the speakers and the participants that I could see. They've been really numerous. So on my side, I want just to recommend you to stay tuned. Both EDHEC-Risk Institute and LTI have numerous initiatives underway in terms of research, education, and future events. So stay tuned and help us in this important sort of mission, not just for academia, but also to try to help the business and the financial system. Thank you very much. Elisa.
Thank you, Gianfranco. Thank you to all the speakers. And Gianfranco summarized very well also my point of view. In particular, LTI will launch very soon a call for fellowships. So please visit our website. And in case you or your colleagues are interested, we will welcome your application very warmly. And thank you very much to all the three of you for today's contribution and for having helped us to learn something more. Okay, bye-bye to everybody. Thanks to the participants too.
Thank
Bye.
you. Thank you.
Bye.
Bye-bye.